Paying with Equity, prepared for and presented at the 2016 Square One Entrepreneurship Training Program. Square One is a program of the Center for Emerging Technologies. CET is an affiliate of the Cortex Innovation Community. Square One is funded in part by the Missouri Technology Corporation.
So what I'm going to do tonight is go through the basic types of equity compensation. The beautiful thing about equity compensation is that these are all based on contracts that are drafted by attorneys who happen to be very creative people. So while we have these general boxes, it's very easy for them to get more complicated and to take on aspects of different types of equity compensation. So keep that in mind as we go through. As we go through, feel free to throw out questions to help clarify or to talk about your situation or whatever might be helpful for you. I mostly want this to have something for everyone to learn tonight. Oops, maybe I'm not hitting my button. There we go. Okay, so to start is just kind of a generic, why do people ever do this? Why do people want to give away part of their company to somebody who's doing work for them? So I stole this little chart. I don't know if you guys have this. They received the PowerPoint. Okay, cool. Okay, so it's kind of hard to read from way up here, but I stole this little chart from another website. I don't agree 100% with it, but I like what it makes you think about. So along the side the top row is paying people with stock, and the bottom is paying them with straight cash. And on the bottom, these are kind of like part-time folks, and these are kind of full-time folks. So what this is trying to get across is the people that you want to be paying with equity are the ones who have some sort of permanent investment in the future of your company because they want to be around with that company for a long time. So that's what they're trying to get across here. The cash ones are more people that are coming in and out or that you don't necessarily want to be tied to for the lifetime of your company. So that's kind of the thought there. Some of the pros I think some of this is kind of obvious. If you're going to give away a little piece of your company, then you're tying that person to you, and they're going to be interested in that future appreciation. So hopefully it will incentivize them to work a little harder for you and the company in general. Some of the cons, though, are that equity compensation can be really complex. You'll have to pay an attorney to draft paperwork. Likely you'll have to bring in a CPA at some point along the way to do the annual reporting or to figure out what kind of deduction to put on your tax return or to make sure that things are being taxed appropriately as you go. The other complication is their value. Since the value is based on what your company is worth, there's questions about what day you value it, what do you base that valuation on, and all kinds of things in that spectrum. So the valuation of a company is itself an entire presentation. And so I don't purport to be any kind of valuation specialist, but just know that it can be quite complex. So I just thought I'd throw some fun examples of where all of us want our companies to head, where we can compensate people with stock, not ever have to come out of pocket with cash, and still make millionaires. That's the goal, right? Yes. So anyway, these are just some fun examples that I found out in the Google sphere. Okay, so to get started, the first most basic type of stock compensation is to give away a straight share of your stock. We typically give away restricted stock because we want to make sure that when we give it out, there's some kind of restriction, like they can't just go transfer it to anybody they want. We don't want to be a publicly traded company yet. We want to keep things a little closer. Or you want them to stay around for a little bit, and so you put a time restriction on it. So when you give away that stock, if you don't put any kind of time restriction on it, then they're going to be taxed on that piece of paper the day they receive it, because that is considered property. So then the value that they're going to have to include in income is going to be based on the value of your company on that day. And the company will then be able to take a tax deduction for whatever value they've given out. So there's kind of parity within the tax rules. If one person picks up income, another picks up expense. So pretty straightforward until we add those restrictions in for time. What that does is add a little measure of tax complication because the IRS has offered us what we call an 83B election, which is essentially a trade. they'll say, if you don't want to wait until all those restrictions lapse and the company grows in value to determine what value to include in someone's paycheck, we'll make you a deal. Pay us income tax today, and we'll let you use today's value of the company. For a lot of our startups, this is a great answer, because if you're pre-revenue and don't have any like signed contracts for sales, there's likely going to be a really small value assigned to your company today on the grant. It might even be zero. So when we go to the IRS and say, I'll take that deal, I'm going to pay on today's value, you'll pay on zero. Then when they sell the company down the road, they'll have a capital gain on that difference between the value they paid on the day of the compensation versus the day that they sell. If they wait until the vesting happens to pick up that compensation, then their value basis when considering what their gain is on the ultimate sale of the company is going to be that difference in what they picked up in compensation on the later date versus when they sell it at the end. So I think that's the big deal about restricted stock. Are there any questions on what restricted stock is? Yeah.
So people already have the company, they already had the stock, we didn't do that. Right? So at this point, it's
Yeah.
to do it.
The 83B election?
Still small. We already 3 years, but we didn't know that.
Yeah, and we see that happen a lot. So you have a couple of options. You could rescind the stock entirely and reissue it, but then you'll have to use today's value of the company. We can't ever go back in time, really. The 83B election has to be made within 30 days of the original grant of the stock. So if you're outside that 30-day window, you won't be able to take advantage of that trade-off with the IRS. But we do see a lot of companies decide to rescind all those agreements and start over and reissue from that day's value to make that all work out. So talk to your attorney. Yes?
Hi, I just wanted to ask, can you clarify whether or not you have to file an 83B election on founder stock? I don't believe you do, right?
No, because it hasn't been granted in exchange for services. And what the IRS is looking for is someone doing work for someone else and getting something of value for that and not picking up the income.
So I just wanted to make sure everybody understood it's not necessarily file on the founder stock.
Yeah, very good point. Very good point. Yeah.
Besides delaying the, limiting the time, boy, I'm not sure about this.
The vesting.
Besides forcing the delay of the sale of stock, restricted stock, are there any other common types of restrictions that businesses utilize?
Yeah, a lot of times they're based on events that happen within the company. So sometimes people don't vest until there's an equity event of a certain size or some kind of event that happens within the company, or that person achieves some set goal within the company, like a certain number of sales for a salesperson or something. Yeah, so there can be all number of different restrictions. It has to be a measurable restriction to fit within the rules to get the 83B election to work. But there's a lot of flexibility within that.
By measurable, it can just be a certain amount of time that goes by.
Yeah,
right?
yeah.
Yeah. So is this restricted stock and common stocks, a company can issue mixed both common stock and restricted stock?
So restricted stock is an IRS definition of a piece of any kind of stock that has restrictions attached to it. So one's a subset of the other, really. Does that make sense?
But what's the difference from the common stock?
So-
We issue different stock.
So if you're going to issue restricted stock in exchange for someone doing services for your company, you can determine whether the underlying stock that they're being granted is common stock or preferred stock. That's all of those can be offered as a restricted type of stock. Does that make sense?
So the total pie that can be a restricted stock is that. So then you can go.
So let me back up one step. Yeah. No, I see where you're going. So when a company is formed, they work with their attorney to set up their base of allowable stock, And that can get adjusted as you go through time. If you decide to, open a new round and create some new preferred stock, you can adjust that, the list of available stock. But until you issue it to someone, it's still part of the company's stock. Within your inventory of stock, you can have common stock, preferred stock, whatever. If you would like to give away some of your stock in exchange for services, then you can set up what we call a restricted stock plan that says, okay, we're taking this number of shares out of our pool and we're setting them aside and we're putting these certain restrictions on them, and over time we're going to grant those to our employees. So it's taking what's already in your pool of stock and setting them aside with certain restrictions. Does that help? Okay, good. Yeah.
So, how would you be paying yourself in the same fashion as whatever structure you set up with your restricted stock and other employees, whatever measure they have to meet? Or
So the terms under, I think what you're asking is, and correct me, is do I get to pick what activities they do that I give them stock for?
no, yeah, right, because I don't really understand my question
Oh, sorry.
completely, because I don't understand the idea completely. But so let's pretend that you only paid everybody who was not not part-time.
Uh-huh.
You paid all your full-time employees, but restricted stock from the word go.
Okay.
How
So
would
no
you-
cash was going out to employees. Okay.
That was even possible.
You're a
How
lucky
would you pay
person if you-
yourself?
You can pay yourself through the restricted stock plan.
Oh, okay.
hmm Yeah, as long as you're performing services for the company, you can be compensated that way as well. Yeah.
But if there's a law say you cannot discriminate other people, you only maybe pay the similar on other people.
So when it comes to compensation, and you're talking about ERISA rules and the rules for paying people, I would suggest asking an attorney who knows those rules. But for restricted stock, as long as your board has approved those shares, you can grant them, as long as it meets your plan, you can grant them at will. So I know when it comes to a 401k plan or a retirement plan, there's a lot of restrictions about discriminating, but I'm not aware of as many here. But again, ask someone who's a compensation expert on the law side for that for sure. Yeah. Yeah.
Sorry.
No.
So the way this works is if I grant restricted stock, the employee pays tax on the value of their invests.
Yes.
And they also pay capital gains when they sell.
Yes.
And the 83B just means that when it vests, it has a lower value.
It means instead of waiting till it vests, you get to pick up that day's value on date of grant. So you kind of pull it forward. Yeah, yeah. So one other quick designation about restricted stock that I should have made apparent in the beginning. This is for a stock-based company, which is going to be a C corporation, and sometimes an S corporation, although there's a lot of restrictions with S corps, so we don't see it there as often because you can't have two classes of stock in an S corp, so it's a little harder. A lot of startups start out as an LLC, and I will be talking about some great options for LLCs that are a lot simpler. I know. But it helps to understand how it works in a C Corp to then understand why it's much simpler at the LLC. So we will get there. But keep in mind, this is mostly at a C Corp kind of company. Okay, anything else? Yeah. You're fine.
And, as a small business owner, so we actually didn't know that. We given the employee actually certain stock, common stock.
Okay.
Is that give us kind of risky or compare with give a restricted stock?
Yes. Well, if you just gave them straight out stock,
Right.
the 83B election is not available because you didn't put any restrictions on it.
Right.
So what should have happened on the day that they were given that stock is they should have picked up income to the extent of the value of the company on that day. So your risk is limited to that value, the company's value on that day, times the income tax rate, so 35%. And then there's some withholding taxes that would apply and employment taxes, so Social Security and Medicare.
So say the
So-
employee maybe leave and then transfer their stuff to other people. It's no
It could, yeah.
Okay, this might be a stock 101 question, but, okay, say I get stock. When and how does it actually turn into cash? Like, if I have restrictions on it, do I sell my stock? Like, who can I sell it to? And when does it actually turn into money?
Yeah, the only time it turns into money is when you give up your shares and get someone else to pay you for them. So very much like if you were to go to a broker and invest in some big company, buy Walmart stock or something, you would not get your cash back until you sold that stock.
And then like restrictions, you can't necessarily just sell it to whoever you want. Like, can like the company say like, you have to first,
Yes.
let me buy it back from you type of a deal?
Yes. So sometimes it's a right of first refusal for the company. Sometimes it's a list of allowable investors that you can sell it to. But yeah,
But you
keeps it in the
won't get
family.
any kind of compensation until you sell your stock.
That's
What if
correct.
Well, what about if the company sells? Like, what if they
Yeah.
sell the company, then you get a percentage of that?
Yeah, because if it's a C corporation and someone comes in to buy that company, one way they can buy that company is to buy all the shares up. So they would be your seller, and they would be the one then giving money actually to the shareholders, not to the company itself.
But then if I didn't want to sell my stock and someone could buy the company, I can still hold on to my stock, correct?
Sometimes
Oh,
you gotta
it's not
read
really
you gotta read the fine print, because sometimes you have to own a certain percentage of the company in order to have that kind of leverage.
Okay,
Yeah.
perfect. Thank you.
Yeah, sure. Anything else restricted stock? Okay, we're gonna move on to a little more complicated ones. Okay. Okay, so next up is phantom stock or stock appreciation rights. So this one is typically based on the value of your company or a value of certain number of shares of stock, but it's typically paid in cash. So it's one way to kind of have the best of both worlds, to tell people that you're going to pay them based on an increase in value of the company, but you're not actually giving away any of the ownership of your company. So this one doesn't have any fancy taxation. Maybe this one is simpler than restricted stock. Doesn't have any 83B election available or anything like that. It's taxed when people are given the cash. The one caveat to watch out for is that if you have this in a written plan, you may trigger what we call a 409A issue, which is a deferred compensation issue. The IRS has said, we understand that people are promising to pay this year's salary in a couple years, but only if you meet certain restrictions can you do that without paying the taxes on it today. And I have a slide later that goes over those rules, because that comes up in stock options as well. So that's just one thing to keep in mind with this one. And as you mentioned with the 401k, since this one is more akin to a cash compensation plan, similar to like a 401k or a retirement plan, there are some more ERISA complications here, so make sure you're talking to your employment attorney on this one. Okay, that one was simpler, right? Yeah. How is this different than options? It's not convertible into the shares of stock itself, it's just paid in cash usually. Sometimes it is paid in stock, which makes them somewhat similar, but they're just different terminology and different mechanisms for determining the value. Yeah,
Is this from the stock again, from the original pile?
No, this is usually based on the value of that stock. So you would look at the day that you make this agreement compared to whatever future date that you promised to pay them on, and you would look at the change in value of the stock and then pay them based on that difference, but you wouldn't give them any stock. You would pay that in cash, but you would reference the value of the company to determine what you're going to pay. Does that make sense? Okay, good. We can talk more later if there's more. Okay, anything else on phantom stock or stock appreciation rights? Phantom stock, by the way, works in partnerships and corporations. It's just all based on the underlying value of the stock, of the equity of the company. Okay, incentive stock options. So incentive stock option is a term that you hear a lot. And the IRS has created a special code section for it. What we see happen is that people issue stock options under an incentive stock option plan, but then break one of the pieces of the rules for it to qualify as an ISO, an incentive stock option, and it becomes a non-qualified stock option. So you may have heard both terms, and that's kind of how they're related. They start as a regular incentive stock option, but can become non-qualified if they fail the tests. Okay, so, and I have the tests on the next slide. So, oh wait, yeah, I do. Okay, sorry. Okay, so what are stock options? Stock options are not property. They are considered an intangible because it's the right to something. It's not the thing itself. It's not the stock itself. It's the right to buy the stock. So when you're granting stock options, you're saying to someone, if you do this amount of work for me, then I'm going to give you some options that you can spend some of your own money to buy the company. So there's usually a strike price. There has to be a strike price. So the idea is that you're going to grant the option today and that they're going to be able to hold that option for a few years. And then when they exercise that option, they're going to pay the price that you promised back at day one, but they're going to be given stock that's valued higher because your company will, of course, have increased in value by that point. So that's the incentive with stock options, is that they're granted it. If they stay around a while, they'll get some great value out of the company, and they'll get to pay the price from years ago. So ISOs, if they are granted and do qualify as a true ISO, they are not taxed for regular tax purposes to the employee, which is awesome. But it also means that if no one's picking up income, no one gets a deduction. So the company does not get a tax deduction for granting or for someone exercising an ISO. When the person exercises the ISO and then later sells that stock, the underlying stock that they have, on that date they will then get capital gains rates based on whatever their strike price was to purchase the stock when they exercise their option. So in that regard, very similar to the taxation on restricted stock at the end. Does everybody know what AMT is? So in the tax code, for all individuals, there's regular tax, but then we have what we call the alternative minimum tax. About 60 years ago or so, the IRS decided that the best way to tax the rich more is to give them a lower minimum that they have to pay on taxes. So it starts to kick in around the $200,000 of income mark, and it's a mandatory 28% tax rate for income somewhere between $200,000 to about $450,000, and then after that point, your rate's 39.6%. So when calculating AMT, though, it's not very straightforward because there's a whole page of regular tax deductions that are not allowed for AMT. And there's several income items that are not allowed for AMT or that are taxed differently for AMT. So one of the differences is that ISOs must be taxed for AMT purposes. So if you have employees that are making significant income or have spouses making significant income or something like that, it's no use to them to give them ISOs because they'll wind up being taxed under the AMT rules on that option. Okay. So these are the 7 qualifications to be an ISO. So they have to be granted to an employee. It cannot be granted to someone who is paid under a 1099 for your company. So it can't be a contractor. It can't be someone who comes in every once in a while and does something like it can't be your lawyer, for instance. You can't pay them with an ISO. They would be given a non-qualified option. The exercise price has to be at least equal to the grant date on fair market value. That's an important rule for ISOs as well as non-qualified stock options, but it is a rule for ISOs. So, yeah.
Sorry, just to quickly clarify.
Yeah.
Can it be a part-time employee? In other words, anybody that's paid for on W-2?
Yes. Yeah, anyone paid for on a W-2 qualifies, yeah. Yes, good clarification. ISOs are not allowed to be transferred, except on death. They do understand that part. But they can't be available to the public. So there are some options that are traded, and you can't have one that's available like that. They must be pursuant to a plan, and so you have to have written board minutes or documentation that your board of directors has approved this plan for options in order to qualify for an ISO. They have to be granted within 10 years of that plan. So if you create a plan in 2016, you have to grant all the options to the employees under that plan within that 10-year period. If that period expires, you got to get a new plan. You got to go back to your board and say, okay, now we're ready to issue new options and come to terms there. They also have to be exercised within 10 years of the grant. If someone gets terminated from service or leaves for some reason, that 10-year period goes away and they only have 3 months from the date of their exit from the company. And very important, at any given year, all ISOs exercisable within that year have to remain under $100,000. So public companies have a huge problem with this. Startups usually don't. It is, again, based on the fair market value of the company. But important to keep in mind as your company grows, because when you put that plan into place, your 10-year time clock starts running, and in 10 years, your company may be worth a lot. And so you may wind up with an exercisable value that does start to hit that $100,000. Yeah?
Is that per person? Is that, what is that? That's
For the company.
entire company?
Yeah, yeah.
That's not very much.
Right, right. And if you've issued options over time, you could have a large pool sitting out there waiting to be exercised. So until people actually pull that trigger and exercise their option, they're sitting in that pool still.
Okay, but it says exercisable, so that means you have to look at the whole pool?
Yeah, so,
Or is it the ones that are exercised, that actually are exercised?
no, this is exercisable.
Okay, so it is.
Yeah, so it's people that could exercise. Right, right. Yeah, even harder, right?
Right.
Yeah, exactly.
You also say it's an annual, so what it means is they have 10 years period or it's annual?
Two different bullets. So in any given annual period, when you look at who has options that they're allowed to exercise this year, because sometimes we grant options and say, you can't grant these for you can't exercise these for 3 more years. And so they would not be included in exercisable because they're not allowed to. You would only look at within your calendar year, who's allowed to exercise and what's the value of those options. Yeah. Okay. And I put a quick note at the bottom. If you're exercising to someone who owns 10% or more of the company, there's some additional rules. Some of these thresholds are brought down. It's a little bit harder. So if you've got a really active person that you've been granting to over time, sometimes this gets tripped accidentally. Okay, so that's the basics of incentive stock options. I'm going to flip to non-qualified stock options, and then we can cover questions over all options, if that's okay. Yep.
I don't understand though, the big companies have incentive stock options that are millions.
Yeah,
How come they don't trip for 100 a day?
they do. They do. Their plan is set up as an ISO plan, but every year they have to look at whether this year's option exercises qualify, and if they don't, they're non-qualified.
Oh, okay.
Yeah.
They're non-qualified and this doesn't matter.
Exactly. Right. Yeah, and actually on 10Ks for companies, you'll actually see a footnote that talks about it, and it'll talk about whether they did qualify or not, and then you'll see references to it in their tax footnote as well. And if they are showing a tax deduction for it, then they're non-qualified options.
Okay, great.
Okay, so non-qualified. So this is any option that is either fails one of the tests or is issued as a separate plan from the ISO plans. Okay, so when they are exercised, they are taxed on the difference between the value that you pay and the value that the company is worth on that day. And that sets your basis. And so then when you sell years down the road, the gain is going to be a capital gain, and it's going to be based on the difference between the basis, which is what you paid, and the value on the day that you sell it. And that part's going to be capital gain. Yep.
What's the tax percentage on capital gains in the US?
20%. Yeah, yeah. There's some extras for Obamacare once your income's over $400,000, that would increase it a little bit more too.
And with capital gains, you have to hold it for what, a year?
A year. That's right. A year.
So there is a requirement, the time requirement.
Yes. That's right. That's right. Let's see. Oh, so 409A. 409A is again that deferred compensation plan. The critical piece to avoid triggering 409A is that when you grant that option, the day of grant, their strike price needs to equal the value of the company or be higher. So we see a lot of companies that issue penny stock options. If your company's value increases beyond a penny and you issue those options at a date when your value is higher than a penny, then you're going to wind up with a tax problem on the day that you issue those options. Because the IRS says you're already giving away something of value. You've already given them a discount on today's value of the company. So the preference is that your plan is written to state that the value will be based on the grant date value, and then that will change over time as you issue the options. It'll just be based on whatever that day's current value is. Does that make sense? So if that does not happen, the consequence is both an income tax consequence to the employee, but also a withholding and payroll tax consequence to the company. So your risk there is that the IRS would come in and say, no, these options do not qualify for no taxation today. They need to be taxed on the date that they were granted, and the company failed to pay those payroll taxes associated with that compensation. Does that make sense? So I think I have, no, yeah. So I keep referencing 409A, so I'll go back to the partnership profits interest, which is going to be your favorite, I promise. But 409A, so here in the slide deck, I kind of put the nitty-gritty of the rules in here. So 409A comes into play anytime you promise to pay someone this year's salary in a future period. If you can meet these qualifications, these 5 things, then it's okay. You can defer that compensation without a current tax event. But if you can't meet these 5 things, then you've got a tax exposure issue. So just real quick to go over the 5 things. It has to be a legally binding obligation. So you want to make sure that there's a written agreement in place. Doesn't necessarily have to be drafted with a lawyer. I would recommend it because it's safer. But as long as it's written and as long as both parties have agreed to it, then it's a legally binding agreement. It has to be in writing. So you can't say, oh, we had a verbal contract. It has to be in writing with contemporaneous documentation. It has to be made in advance of the services being rendered. So you can't get to the end of 2015 and then say, oh, never mind, we can't pay people this year, we'll pay you next year. You can't do that. You have to do it before they render those services. The time and form of payment has to be determined up front. So sometimes we see plans go into place that say, we're going to pay you whenever we have cash. And that's too nebulous. It's not concrete enough. You can say things like, when we receive our first round of funding equal to $5 million or more, that is a determinable event. But it has to be a concrete thing that's determinable. And accelerated payments cannot be made. So if you tell someone, I'm not going to pay you until we have this $5 million round, and then you have some extra cash at one point and go ahead and pay them a little bit of what you've owed, that will bust your plan, and you'll have an IRS exposure issue there. Does that make sense? It's 409, yeah.
I was just going to ask, does this apply to, say, sole proprietorships, or no?
Yeah. Yeah, well, it would apply to anyone paying someone for services as an employee. Yeah. Now, if you're making some agreement with a supplier or with some other third party that's kind of their own entity, it would be a different concept. But this is paying someone in exchange for services that they're providing to you.
So you said this was new or maybe misunderstood?
No, it came out probably 10 years ago. Yeah, it's been around a while. Yeah. Anything else, 409A? Okay, profits interests. How many are LLCs or partnerships? That's what I thought. Okay, so the IRS has a special code section just for you. So if you would like to give away a little bit of your company, but don't want to have to deal with compensation issues, and you don't want to have to deal with valuing your stock or all that kind of stuff, you can issue what we call a partnership profits interest. So a couple caveats though. So what a partnership profits interest is a promise to make someone a partner and to pay them once the company achieves a certain level of profits. So sometimes it's when the company breaks even, then from that point forward, you're gonna give them 5% of whatever the company makes after that point. Sometimes it's a higher level than that. Sometimes it's, when we reach profits of $1 million on an annual basis or something like that. Sometimes it is based on the internal value of the company. So similar to a C corporation, if you were to value what the equity interests of the company are, sometimes the profits interest is based on that. Once the value of the company as a whole is worth $5 million or something like that, then they will receive 5% of the company. Two big caveats. If you do this, they are a partner. Even if you haven't achieved that level of profit, you've said that you want them to be an owner with you, and they are a partner. So partners cannot be employees. Partners are paid through a guaranteed payment. So sometimes that gets a little bit ugly because they're paying all their own self-employment taxes and Social Security rather than having the company withhold, and that's a big change for a lot of people. So be very cognizant of that. And if you have a defined benefit plan, they can't participate in that plan because partners are not allowed to be in that plan. And so you could run into some other benefit issues with them. So those are my two caveats, but it works really, really well in growing startups that want to avoid some of the more complicated equity compensation issues. So, yep.
Can you talk a little more about the implications on personal taxes of those people? I know you mentioned it, and,
Yeah.
and like I've been through it, but
Yeah, what it means.
the difference between what you're used to doing with your taxes and what it means.
Yeah.
Talk a little bit about that.
Yeah. So an employee is paid through a W-2, and the company takes their gross salary and nets it against income tax withholdings, which they submit to the IRS, state income tax withholdings, which they submit to the states, and Social Security and Medicare, and then the company pays like your unemployment taxes and other kinds of withholding. If you're a partner in a company, you cannot participate as a W-2 employee anymore. And we take that bucket of Social Security and Medicare, which in an employment situation is paid half by the employee and half by the company. So whatever you're seeing on your W-2 as being taken out as Social Security and Medicare, your employer is actually matching that when they submit that to the IRS. So on a partner's 1040, where there's a special form where you pay what we call self-employment tax and essentially pay all that Social Security and Medicare yourself. So it adds another 14.9% to your individual tax rate.
And that's on the deferred revenue to the partnership or only distributed?
It would be on any current income. So it would be on distributable income that's allocated to the partner as well as guaranteed payments, which would be cash payments that are made to the partner.
And you usually, correct me if I'm wrong, you usually make those payments quarterly. So it's
Yes.
it's a different move.
Yes.
If you're used to paying taxes once a year, you start having to estimate taxes and pay government quarterly.
Yes, that's correct. Yeah. So, questions on profits interest? Or taxation of the partner versus employee? All right. It just has some summary. Yeah. Okay, so,
I have a question about the profits, because I've done LLCs that have a stock option plan, but they are not treated as partners. Is that because they're treated taxed as a corporation?
So options would be different because options are a right to buy some of the shares or some of the LLC interests, but they're not the actual LLC interests. And those wouldn't be considered a partner until they actually exercise them.
Yeah. So I think that's what, in practice, most people do not make you a full partner because of that tax implication for the employee, because you don't want a bunch of employees responsible for their own taxes.
Yeah, I will say the words that you're saying are very important because I think a lot of people use a profits interest to mean what you're saying, but their plan documents don't actually reflect it, and so they accidentally get there.
Have a separate plan, it's all in writing, and the lawyer would help you do all that, and you have to get a lawyer to help you do that.
Yeah.
But I think in practice that you would probably want to do that versus making these people employees, except for maybe your real founding partners, you all treat it as profit center guys. And then, but when you start getting, maybe more than 3 or 4 of you, you start paying those people as employees, W-2 them. And, because most people are not going to understand this tax implication of having to pay quarterly taxes and save out that money, right?
It's a big change if you're not used to it.
Yeah, the first year is always really painful. Yeah.
And the questioner said something very important. You're going to want to consult an attorney, not only for what the specific topic you're talking about, but kind of all the stuff, I think. And I think that's
Yeah,
really
this is one
important.
area where you really do need
Sure.
legal.
And they should be your
I've been
attorney.
doing it for 20 years and I still, when it comes to this, I do lawyers.
Amen, me too.
Yeah, it's worth, and also having a lawyer that communicates very well with your accountant makes this a lot smoother. So your lawyer should know who your accountant is, and they should talk a lot during the taxation part of the year. So, yeah.
Definitely. One little word can change the taxation really quickly, so. Yeah.
Just want to ask, if you're just starting out, and let's say the first couple of years, you're not making a profit, so will there be significant changes with that, net loss? Because you have a bunch of expenses, but maybe your revenues don't quite meet the expenses, so you have an operating loss.
Yeah, significant changes to what a profits interest means? Or,
Yeah.
yeah, because you could set that profit level to be later when you actually have profits. And so they wouldn't necessarily be granted that now. They could be granted that later, or it could be set on the value that will happen later. Yeah. Yep.
So, say you say about the value of the stock. So every year maybe changing it. But for small business, maybe don't really value a company. How you get that value, say, this year is different from first year.
So the question is, how do you get the value?
Yeah.
So the IRS approved way of getting the value is to get what we call a 409A valuation done. And some CPAs will come in, look at different metrics of your company. A lot of the stuff that's going to be in the financial metrics discussion today is what they will look at to value that company. And they would do that on an annual basis. We see those reports costing somewhere between $4,000 and $10,000 usually. So a lot of companies aren't going to do that on an annual basis. As a practical matter, you could come up with your own valuation, but you would have to know that you're taking a risk that if the IRS comes in and tries to audit that they get the benefit of hindsight. So make sure that you're talking it through in detail with your advisors to make sure that that is a defendable position for the company. But if you have no revenue, no promises of revenue, if you don't have a finished product yet, it's going to be pretty easy to get to a pretty low valuation, in my opinion.
However, Charles, grant revenue does count as revenue.
Yes, it does.
So in your case, if that's successful SBIRs, you wouldn't need to pay attention.
Darn. Yep.
And then I have one other question. If I have a 501c3 or nonprofit, would any of this apply to my nonprofit? I can still
Yeah.
issue stock?
Well, so wait, the entity that you own is a 501c3? So all of these concepts will apply because the compensation rules for employees of 501c3s are pretty much the same, but you may not have a stock-based company. You may be based on a trust. I don't know which. Usually 501c3s are either a trust or a corp. And so the underlying stock of the company may not be something you can give away. But some of the 409A concept would apply for sure. Yeah.
So when you get the SBR or grant revenue, so that's tax that is revenue and
Well, so you're subject to corporate income tax if your revenue exceeds your expenses.
Okay.
But
if you
typically
spend
the
all your-
grant,
Okay.
you have to justify all the expenses you're going to have. So they typically don't if they're properly accounted for.
Right. Especially in an accrual-based company, because at the end of the year, that's a lot of the tax planning that we do with startups is making sure that they've accrued for all those expenses that will go against the grant.
And most grants, actually, you can only draw down the money when it's time to pay the expenses. So.
Okay, got it. Now, I was thinking like an employee, but I have to think of you have the money and then
You're a CEO now, baby.
you take the expenses out and then you calculate the taxes.
Yeah.
So that's awesome. That's interesting.
Okay, so the last caveat that I like to throw out, because we ran into it a few times and it's really ugly. If you are contemplating an equity incentive plan of any type, make sure that the underlying stock that backs up that plan has been approved by your board. We've had folks in the past who have had grand plans of issuing all this equity compensation, but they never went back to their books and their legal documents to actually issue the stock that supports that plan. And if you issue stock that's not in your plan, you've got a bad legal problem. So just keep that in mind. Okay, I think that's all my stuff. So any other questions on equity comp? Yeah.
Question. One of the things on the stock option is, when you talked about it just briefly, was that you have to hold it to get the capital gains treatment.
Yes.
So if if you have a stock option that is valuable and you think the company is about to sell, I mean, this is more for the employees than for the owners, but if you own stock options yourself, you need to make sure that you get through that waiting period before the company is sold.
That's right. That's a 1 year period.
And so is there a workaround for that, or what do people strategize to do?
Usually not, because there's not a big enough window for people to exercise it. Now, what will happen is that the check that's issued is typically net of the taxes.
Yeah.
So we do some calculations on an exit event to determine what cash needs to go out in order to pay those employment taxes. That then changes the working capital calculation for the total exit number. So it kind of becomes a circular calc, but we take care of all that on that last check. But it does become an ordinary income event to the employee
If they haven't done it.
if they haven't held the stock itself for a year or more. Yeah. But at least they'll have the cash to pay the taxes.
It's a good problem, I guess.
That's right, that's right. All right, anything else? All right, well, thank you all.